So this is my talk on kind of understanding the cryptocurrency industry. My name is Birchell Eversole. Sorry. I am a software engineer. I currently work in the financial industry. I've been working with cryptocurrencies since college, around 2016. I first started with reading about Bitcoin, becoming really interested in it, and I've been working with it since then. I'm also an aspiring entrepreneur. One of the main reasons why I joined the Power MBA, because I was really interested in learning about marketing. The pitch was really appealing to me, so I've been kind of working on projects for, ever since high school. So I first want to give an overview on what this presentation will be about and what it won't be about. So we're going to talk about the underlying technology and innovations of cryptocurrency and blockchain, and also the history of it and where I think it might be going in the future. But we're not going to talk about, how to make money trading cryptocurrency. Cryptocurrency can be really volatile, and you should be prepared to lose any sort of money that you put into the industry. And also, just as a disclaimer, I'm not an investment professional, and none of the cryptocurrencies that I talk here about in the presentation, you should not consider it as a solicitation to purchase or invest in those cryptocurrencies. So now that we kind of have that disclaimer out of the way, let's jump into what is a cryptocurrency. So I think it was a bit of a struggle trying to come up with a simple definition, and I settled on just describing it as a digital transaction system that works without a trusted authority. So you have banks, you have fiat currency, and these are transaction systems that work with the help and effort of a central authority that manages things. With a government, you have the Federal Reserve, you have monetary policy. With a bank, you have the employees at the bank working on the working with a database, making sure that when you put money in, you can take it out later. So cryptocurrency is this transactional system where you can transact money or some form of asset, but it does not have a centralized trusted authority which controls it or facilitates it. So now I'll kind of jump into a bit more of a technical definition. And if this seems like a lot of different words that don't make any sense, that's no problem, because I'm going to go down and I'm going to break down each of these definitions or each of these words and focus on the meaning, just so we can kind of get an overview of what a cryptocurrency is. So this definition, which is a cryptocurrency being a decentralized digital asset, which is used as a medium of exchange where transactions are stored in a blockchain. So decentralized, and I talked about this a little bit before when I was using the example of banks or fiat currency. A decentralized just means there's no central authority controlling distribution or controlling how the system is run. So banks and fiat currency, as I talked about earlier, they either have a bank who controls the transactional system, or they have a government backing the currency. So next we have a digital asset, and this is a really broad term. A movie file can be considered a digital asset. A picture could be considered a digital asset. It's really anything that just exists in a digital format. And in the case of cryptocurrency, it's something that can actually hold value. Next, we have a medium of exchange. And a medium of exchange is an asset that's meant to be exchanged for goods or services, essentially fiat currency. You don't really see too many examples of other medium of exchanges. One example that I like to use is, for example, in the prison system, since inmates are not allowed to use fiat currency, they will use packs of ramen or cigarettes as a medium of exchange, because it's something that will store for a long time and is considered to be valuable, is just considered to be generally valuable. So it's used as a medium of exchange. And finally, we get to the blockchain. So here I included the kind of the technical definition, and I'm going to explain it more on the next slide, but for now we'll just refer to it as a distributed, decentralized, and public ledger, which is secured through cryptography. So we're going to dig into that, and I tried to come up with another simplified definition of what is a blockchain. Similar to a cryptocurrency, a blockchain is a way to securely manage and store transactions without a trusted authority. So you'll notice that this is very similar to the definition that I gave for cryptocurrency. And that's because these are very closely linked. The blockchain is the key innovation that makes a cryptocurrency, so it's pretty difficult to separate them. The way that I think about it and the way I want to explain it is that a cryptocurrency refers to the system around a decentralized, with a transaction system, sorry, a system which is for transactions without a trusted authority, while the blockchain is more for the storage of those transactions. So here I've included a diagram to kind of show exactly what the blockchain is. Like the name suggests, a blockchain is a chain of blocks, and a block contains a number of different transactions. So the account balance of, say, Bitcoin, for example, you calculate that by summing up all of the transactions in all of the blocks in the blockchain. So in this example, on the bottom, you'll see I have account balances for 3 hypothetical people, Bob, Sally, and Fred. And then in the blocks, you'll see a transaction. In the third block, you'll see Bob sent $100 to Sally. So in the second block, you'll see the state of the blockchain and the account values where Bob has $1,000, Sally has $200, and Fred has 0. Once a transaction has been included in a block and is added to the blockchain, now these account balances change. And the important thing to note here is that these account balances are not stored anywhere. These account balances are calculated based on the transactions stored in the blockchain. You'll notice that in the last block, Fred tried to send some money, but Fred was not able to because Fred doesn't have any money to send. And that's a very simple way to explain that the blockchain can keep track of these things and stop any sort of transactions from occurring, which would not be valid. So now I want to break down the technical definition, kind of like I did for cryptocurrency. And there's a little bit of review here, but you just kind of wanted to go through and break it down. So first, distributed. And the concept of blockchain and cryptocurrency being distributed also comes with that decentralization. The processing and storage of the transactions in the blockchain is distributed across many different nodes, also known as miners, in the network. So the data that's stored in the blockchain will be stored in hundreds or thousands of different places, and hundreds or thousands of these miners are contributing to the system in processing transactions. Next, we have decentralized, which we used in the last definition. And this is just, and in this context, I wanted to bring it up because any entity can technically write transactions to the blockchain. So, I mean, I could go and I could download the Bitcoin blockchain, and then I could write a new block to it and say, I just received $1 million. And anyone can technically do that. The innovation is around preventing people from doing that in a way, and I'm not going to go too much into it just because it can get kind of complicated. It's these ideas of consensus and figuring out what is a valid transaction. But this idea of decentralization is, anyone can write transactions to the blockchain. So how do you create a transactional system that anyone can write to that is still going to be accurate, that is not going to allow people to abuse that? Next, we have the term public ledger. And a ledger is just a term for something storing information around financial accounts. And in this case, the blockchain is a public ledger because anybody can download the Bitcoin blockchain and really just read through all of the transactions if they're interested. All the transactions in Bitcoin are public. And next, I want to talk about cryptography. And I won't go too deep into this. It's one of the key innovations for blockchain, but it also can get really dense. And I thought it was a little bit out of scope for this presentation. But the basics are, cryptography is a science around secure communication or authentication in an adversarial network. And something I want to focus on here is the adversarial network part. And what I was referring to before, the challenge with this sort of open transaction system is that people would want to abuse it. People would want to take Bitcoin and say, yeah, I have received $1 million, because they get $1 million. But with these advances in cryptography and how they're applied in the blockchain, it prevents this, which I won't go into too much detail how it works. But the basics is, with an open transaction system like this, it's an adversarial network. There are people who would want to abuse the system. And cryptography is the science around kind of protecting that and preventing these things from occurring in these adversarial networks. So now just to get a quick overview or a quick review of the basics. So a cryptocurrency is a digital transaction system that works without a trusted authority, in comparison to traditional transactional systems, which are centralized. The only transactional system that you could argue is not centralized would be something like the bartering system, which we used 700 years ago, where I just said, I have 8 sheep, will you give me some wheat? And that didn't have any central authority. But when we started to introduce the concept of fiat currency, banknotes, there's always been some sort of centralized ownership, some company to hold the money in a bank and say, you give me $100 and I will give you that $100 later. Or a government which backs a currency and says this currency is worth this much. And so cryptocurrency, the innovation here is creating this kind of trustless and open public ledger, which will remain correct. And so I included a couple terms here, which are used in the industry. One is immutable, which is that once the transaction is added to the blockchain, it's permanent, and also verifiably correct, which means that it's difficult to add valid transactions to the network, but it's also really easy to verify them. And this also kind of comes down to cryptography, and we'll talk a little bit about consensus algorithms later in the slides. But the main concept that I want you to take away is that cryptocurrency is a transactional system that works without any sort of trusted authority governing it or controlling it. So I created this diagram just to kind of give an idea of the flow of the blockchain and just kind of visualize it. So you have users who send transactions. Those transactions are then sent to miners, and those miners will mine those transactions into blocks. Miners will actually compete with each other to create the next block in the blockchain. One of the reasons for this is to protect against if just one miner was able to add blocks, he might selectively choose transactions. So by having this competitive space, it makes it harder for anybody to abuse the system. So these miners, while they mine the transactions to blocks, and then once a block is written to the blockchain, then that transaction is considered to be spent or is considered to be confirmed. So there is some time from when I say I want to transact some money for the miner to actually pick up that transaction, mine it into a block, and add that block to the blockchain. So this kind of wraps up the first section of the presentation, where I just kind of want to talk about the basics of cryptocurrency and blockchain. I didn't see any chats, but let me double check just to see. Okay, so yeah, so I guess if anyone has any questions, they could just toss it in the chat, or maybe just come out over voice.
Yeah, I have a question. It's this mining aspect that's taking up so much computer usage, right?
It is, yes.
So have they done simulations or estimations, approximations of if this became completely took everything over, how much would it really monopolize that to an extent that maybe it would be more than we have?
So you're asking, what does it look like as Bitcoin continues to scale, for example, and the amount of computation power increases?
Yeah.
So something I'll actually talk about later is what's known as the scalability problem. And again, this is actually in these later slides, but Bitcoin can only run about 7 transactions per second, which compared to something like Visa, which can run 15,000 transactions per second, there's obviously a very serious problem there. I think one thing that I'll mention here is the computational power that's used to mine Bitcoin is essentially a defense mechanism against someone with superior computing power being able to essentially hack the network. So the reason why this computation level is necessary, and of course this is all just really a theory. Blockchain is a new innovation. This is something that's never really tried before or even existed before. So there's still a lot of experimentation. But the idea is that this computation protects the network. And actually, I included this in the later slides. But for somebody to essentially not modify Bitcoin, but to think of it, you could think of it hacking Bitcoin. You would need almost $56 billion worth of just physical equipment, not to mention the amount of energy that you would need in order to process an invalid transaction. So I don't know if that fully answered your question. I'm not sure that Bitcoin will continue to accelerate in its use of computational resources, because there is kind of a leveling off in terms of computation exchanged or in these cryptocurrencies. Because if you only had 10 miners, you would have a very small level of computational power needed to do this mining. The increase in computational difficulty comes when there's a lot of competition, and this increased amount of competition comes because of how popular this blockchain is. So there definitely is an effect where the more used Bitcoin is, the more people see it as valuable, the more competition there are for miners, and the more computational power that needs to be used. But there definitely is an upper limit for that. And then at some point, I believe things will probably level off, and we'll probably see less computational power being used right now. But I think that's all, it's all speculation on my end.
So one last aspect about that. So the decentralization of this is why illegitimate transactions are sort of a field day, right? Because there really isn't. So it's kind of like a Facebook thing, right? It turned out that people could use it for not good. Is that a concern as well, or are you going to get to that in later slides as well? Maybe I'm jumping.
So I don't actually talk about that in later slides. I was actually reading through a couple of articles about this recently. If you look at how, I think that's one thing that people mention a lot when they think of cryptocurrency. They think of illegitimate transactions. But there were actually some analyses that showed that the traditional monetary system is used far more for illicit activity than something like cryptocurrency. You have money laundering. The U.S. dollar is used, but it's by far the most used currency for illicit activities. And does that mean that we shouldn't have the U.S. dollar, for example, or is that a problem with the U.S. dollar? Not necessarily. And also, actually, one note is some people have talked about how Bitcoin is good for privacy, because even though transactions are public, identities are kept somewhat private. But actually, to some degree, transactions with cryptocurrencies are really easy to trace. And the difficulty is actually associating, say, like an account number on Bitcoin with somebody who's making transactions. But once that's done, you have the whole transaction history. You can very easily run through it and see where all this money has gone, which has been, actually an integral part of many federal investigations involving illicit dealings over Bitcoin. They were able to tie account numbers to cryptocurrency transactions and analyze where that money came from, where that money went, and make arrests using that evidence. All right, I think I saw something in the chat. Let me see. Okay, so we have a question from Tony Balsley. Is the miners concept synonymous across other blockchains, and what are the incentives in non-Bitcoin blockchains? So that's a great question. So one of the reasons why I try to keep this high level is just due to the massive differences in every single cryptocurrency in terms of these incentives for mining. I talk about a couple different kind of incentive-based approaches later on, but I don't go too deeply into it, just because I could give a whole presentation just on Bitcoin's structure in terms of its incentives, its fees, and then I could give a whole other presentation for each other cryptocurrency. And this is because, while they share some common themes, the blockchain being the primary innovation that is shared, it spreads out because in a lot of ways, cryptocurrency and blockchain is a big experiment. People are still trying to learn and understand how this technology can be used. And Bitcoin at 7 transactions per second, I mean, this is just the first one that existed. And because of that, people have been trying to build on it, trying to learn and develop these kind of new sort of incentive mechanisms. So, and just really quickly, just to go a little bit deeper into Bitcoin's incentive mechanism, the incentive for a miner to mine a transaction comes in two forms. There's the block reward and there's the fee. Block rewards are essentially the only way that Bitcoins can be introduced into the system. And when a miner creates a block, they receive a block reward. However, this block reward has a halving period, which means that it decreases over time. And on the flip side, you have the fees. So in order for me to send a transaction, I actually need to pay a fee. So when a miner aggregates a bunch of transactions into a block and writes that block to the blockchain, then they receive all of the fees for all the transactions in that block. So in the Bitcoin white paper, how it's been outlined is that as the block rewards decrease, fees will hypothetically increase in order to not meet, but to replace the Bitcoin halving reward or the Bitcoin block rewards, and therefore creating a self-sustainable system where in order to transact, I pay a fee. Then this fee is passed on to the miner who is actually doing the work to mine this transaction into the network. So that's just kind of an overview of how Bitcoin's incentive structure works. But there are a lot of different incentives in a lot of different different blockchains and cryptocurrencies. So I can't go into all of them, and I will actually talk about a couple separate ones. So we next have a question. Who decides how many blocks there are in a crypto? So specifically in terms of how many blocks, there's no real limit to how many blocks there are. The blockchain is meant to just stretch on until infinity. You have the first one, the second one, third one, and so on and so forth, because adding a block onto the blockchain is integral to processing a transaction. So if you had a limit to the number of blocks in a cryptocurrency or blockchain, then that would mean that you can't transact in it anymore, which would kind of mean that the cryptocurrency is useless. It can't actually do transactions. All right, so and then I'll just continue on unless anybody else has anything else to ask. All right, well, and feel free to add any questions in the chat as they come to you, and also there'll be time at the end for any sort of questions. So now that I've finished talking about what cryptocurrency and what blockchain is, I'm going to go into the history and possibly where it's going. So in the cryptocurrency industry, there's this idea or concept of generations. So the first generation of cryptocurrency is the innovation of blockchain and Bitcoin. So Bitcoin was the first cryptocurrency. It was the first thing that we're aware of that utilizes this concept of a blockchain to create this trustless, decentralized transaction system. One thing to note here is that these first blockchains and cryptocurrencies were purely transactional. They only provide the ability to send and receive transactions. They use proof of work as a consensus algorithm. Proof of work is that mining process that we were discussing earlier, and this is the actual work labeled in proof of work, and I'll actually talk about this more later in the presentation. Some examples of first generation blockchains are Bitcoin, Litecoin, and also Dogecoin, which has been going crazy recently, but it was actually one of the original cryptocurrencies, and it is also purely transactional. So the second generation, and this is more referred to as distributed computing, and this introduces the concept of smart contracts. And smart contracts are decentralized contracts or protocols which actually execute on the blockchain. Another key introduction here is proof of stake for consensus. And proof of stake actually removes the need for the expensive computation in proof of work. And I'll go into the differences between proof of work and proof of stake in a later slide. But some examples of the second generation are Ethereum, EOS, and also Cardano. So I want to dive more into the second generation, and the first section of the presentation really describes the first generation really well. It goes over the idea of this transactional system. But one of the newest innovations, and one of what I would say is one of a really, really important innovation, is this idea of smart contracts and distributed computing. Instead of having the work being done by these computers to secure the network, the work that is being done by these computers can be used to calculate things, to work as smart contracts. Which leads me into the next slide, which is, what are smart contracts? And smart contracts are code which is executed on a blockchain, which is used to automatically perform transactions or other functions. And like the name suggests, smart contracts, they're essentially a replacement for the legal services industry. You know, if you have a contract, I agree to send you $100 and you agree to work with me for, you know, a year or something. That's a contract, but there can be disputes with that. If you don't actually work, or you say you didn't send me the money. And then we have an entire infrastructure made up of lawyers, judges, and courts, which are meant to arbitrate those sorts of disputes around contracts. So smart contracts kind of takes all the complication out of that, where it defines the rules and then automatically executes when certain conditions are met. Of course, this can't work in all cases. You know, if you say you didn't do your work correctly, it's very difficult to say, well, is that yes or no? You know, or it's difficult right now for a computer to decide that. But with the advent of AI and any other technological innovation, this could possibly evolve so that machines could be making these sorts of decisions. But I think I'm getting a little bit ahead of myself. That's all speculation. But so smart contracts are used in decentralized applications and also decentralized finance, which I'll talk about in the next slide. This slide, I want to talk about decentralized finance, decentralized application, also NFTs, or non-fungible tokens, which is another thing that has been going absolutely crazy. So I figured I have to include it in the presentation. But decentralized finance is really just creating smart contract versions of popular financial instruments. So for example, shorts. You know, talking recently, we saw GameStop and the short squeeze. You know, these financial contracts have been entered into for a hedge fund to say short GameStop. You can create smart contracts versions of these financial instruments so that, you know, and I won't go too deep into this, but if you essentially don't have enough collateral to back up your short position, then the smart contract will automatically execute it for you. Another example is, recently there was a hedge fund worth 20 billion that was basically wiped off the map due to some falls in stocks. I don't know how many people heard about that, but this actually caused a lot of issues with many different brokers who were at risk when the value of this hedge fund's ownership kind of dropped to zero. And smart contracts would actually reduce that risk, because if at any point you do not have the collateral to kind of support any of these options, then the smart contract, without any sort of interference, will liquidate your positions and execute these contracts without any need for arbitration or worrying about that sort of stuff. Some other ways decentralized finance has been used: there's currency exchanges, which are truly decentralized. And there's also a new kind of innovation is tokenized securities, where you have securities like, for example, Tesla stock, which has been turned into tokens, which can then be traded on the blockchain. The next thing I want to talk about, oh, it looks like we have a question. So Jor asked, do you think smart contracts would have avoided the 2008 financial crash? You know, that's a good question. I think, from what I know about the 2008 financial crash, it was more around poor financial decisions in the financial industry, and I think the word is over leveraging of certain positions and entering into these risky positions where there just wasn't backing for it. So I don't know if smart contracts could have avoided the financial crash. But that is definitely something that's worth thinking about. And I think the reason why you asked that was because I mentioned, you know, with these hedge funds, these brokers had issues where things are being over leveraged. Yeah, with the smart catch to over leveraging, like not going for short options. Yeah, so it's, unfortunately, smart contracts are limited by the people who write them. So if I write a smart contract similar to the mortgage system that caused the 2008 financial crash, there's nothing that's going to stop me from doing that, and there's nothing that's going to stop other people from entering into that contract. So unfortunately, it's not going to solve all that sort of stuff, but it will certainly make it easier to hold contracts. Smart contracts, when done correctly, in a lot of ways are extremely safe because they will automatically execute and there's no way to kind of get around it. There's no way to avoid sending money because the contract essentially has ownership of the assets. And that contract isn't a person who can be bribed, for example, or could run away with the money. That contract will just execute the terms of the contract when conditions are met. So next I'm going to go into...
So I just got curious. So this whole decentralized is like the main theme for blockchain, right? And this idea of the cryptocurrency. So was this done to cut out the middle person? Is this like dispersion, like direct contact without middlemen, or was this just, if you're going to have a decentralized system, then you can't have contracts that would be powered by an authority?
That's a great question. You know, I'm not sure the motivation behind smart contracts, but and when you talked about taking out the middleman, in a sense, that is what it's doing, but it's also creating more of a trustless system. And we have a lot of middlemen in society, and these middlemen exist for a good reason. Because when I enter into a contract, if you want to know how contracts work, like you need to spend, go to law school, read lots of papers, look at all this case law, and because of that, you have to be paid like $100,000 or like thousands of dollars an hour just to read through these contracts. And so I don't think that smart contracts were really made with the express purpose of removing lawyer as a job option, but it does seem like it could kind of serve that role, removing any sort of middlemen which might have any other sort of incentives, and just creating bare contracts that will execute when conditions are met. And there's certainly a lot of drawbacks, and there's certainly a lot of experimentation. For example, one issue that people find is, smart contracts are not perfect. Sometimes smart contracts have bugs, and there have been many cases in the cryptocurrency industry where a bug has gone out in a smart contract, a person has discovered that bug, and they've used that bug to steal millions of dollars worth of money. And so there's definitely problems with smart contracts. It's definitely not perfect, but it's the concept of smart contracts, I think, is definitely very important. And I think that we are going to see its adoption continue, and we're going to kind of iron out a lot of the issues with it. So next I want to talk about decentralized applications. And decentralized applications refer to applications where the blockchain and smart contracts are used as the database and the backend server. Now, there's also, this could be a whole other presentation. There's something known as Web 3.0, which is all about creating a decentralized web. I'm not going to go into it too much because, again, that could be its own presentation. But the kind of idea is, creating these applications similar to, I mentioned cross-currency exchanges in currency exchanges in decentralized finance. But for example, on something that I've worked with is they have this currency exchange. And this setup of smart contracts and blockchain allows this currency exchange to essentially be hosted by anyone and used safely. So, and it's really interesting because they just give the code out, and then you can go ahead and you can host your own currency exchange because these things are very open, they're decentralized. And so I won't go too much into it, but it's kind of this idea of bringing the decentralization of not just a transactional system, not just computing, but also to applications as well. So finally, I'll talk about NFTs, non-fungible tokens. I won't go too much into it, but these are just tokens that represent unique, which is what non-fungible means, means it's unique. A fungible token like Bitcoin, one Bitcoin is always one Bitcoin. It doesn't matter, if you have one Bitcoin, you have one Bitcoin, but a non-fungible token is something like an art piece. And these can be traded on the blockchain and transacted just like a Bitcoin, but they are just non-fungible in that they are unique. So now I want to go over consensus algorithms, and specifically proof of work versus proof of stake, which are the two kind of biggest ones. So consensus algorithms are pivotal to protecting the integrity of the blockchain. And proof of work specifically, to add transactions, a miner must perform a large amount of computation, which is the work in proof of work. And this key here, which I kind of touched on earlier, is the work is very difficult to perform, but it's very easy to verify. And this innovation comes through cryptography. I won't go into it too much, but essentially, in order to hack the blockchain, and I talked about this earlier, you would need 51% of all the computing power on the network, which, as I mentioned, is around $6 billion worth of just physical hardware of computers, and probably the amount of electricity that Norway uses. So pretty much the only actors who could really have any chance of actually disrupting Bitcoin would be Russia or China. And even then, that would be a really crazy effort to actually correctly do that. So next we have proof of stake. With proof of stake, to add transactions, a miner needs to own a significant portion of the cryptocurrency. And this means that they have the incentive to protect the blockchain, meaning they have stake in the blockchain. So if they were to take actions which would kind of invalidate the blockchain, then that would mean that they would lose their financial investment. Either in, if they hack it and they mess with it, it's not worth as much, or alternatively, there are protocols where if some miners see one miner as performing something or doing something that they see as invalid or as a bad actor, essentially, then they can slash their stake and essentially take their coins. So this concept is that the incentive here is it's not proof of work. It's just, I have a lot of this cryptocurrency, so I'm not going to mess it up because I have financial investment in this cryptocurrency. So let's talk about the third generation. And this is solving the scalability problem. And this is, something that has been the effort of a lot of different, or has taken a lot of effort and a lot of research to try and solve. And this is just basically increasing the transactions per second that these networks can handle. So Bitcoin only can handle 7 transactions per second. Ethereum can handle around 3,000 transactions per second, but something like Visa, which is what you might think of when you think of a payments processor or a transaction system, can handle around 15,000. Now, there are new blockchains that claim to process 1 million transactions per second. One that I've recently worked with, Solana, says they can do 65,000. And they've done this through a number of different innovations. But this is kind of this third generation of, we have this transactional system that works. We have these smart contracts. And now let's figure out, how do we scale this so that it's actually usable at scale? Because it's difficult to run decentralized applications on Ethereum, especially right now, because any sort of transaction that takes place might cost you $50 in Ethereum. And that's just because the transaction speed, you can only do 3,000 transactions per second. And there's so many people competing for this network space that you have to pay high fees in order to get your transaction processed. So if you have an application and you're doing, a very trivial computation on like a smart contract, and it's costing you $50, that application is not going to be viable. So now the focus is on creating these applications where these transaction fees can be at pennies, thousandths of a penny, because you have that really, really high transaction speed. So some other ways people are trying to solve the scalability issue is also by improving existing chains through what's known as layer 2 or sharding. And these are solutions that essentially build new systems on top of existing blockchains like Bitcoin, and settle things essentially off chain, and then do, say, 1 transaction on the Bitcoin network to essentially increase the amount of transactions per second that the blockchain can provide. So you can think of it as, and they say layer 2, that's building on top, and there's sharding, and then that's actually about separating out and having multiple chains which we can actually communicate. So there's a couple of different ideas for scaling. So some examples are Polkadot, and Polkadot uses sharding. Bitcoin Lightning is a layer 2 network that's built on top of Bitcoin. And Solana is one that I mentioned earlier, which uses a couple of different innovations that I won't talk about to hypothetically get up to around 65,000 transactions per second. So now I just want to briefly talk about my thoughts on the future of crypto. So I included a couple different ideas here, and I've talked a little bit through the questions that people have asked. But one is with AI and machine learning, either through AIs that might make decisions on smart contracts, which would be very interesting, or possibly opening up machine learning models to a wider audience and opening up collaboration and contribution to those machine learning algorithms through the blockchain. Another cool idea is actually adoption by government and businesses. So, imagine, all of the bureaucratic slog that goes on in our country and how much of that might be able to be optimized with some sort of smart contract. Imagine the DMV, instead of taking 3 hours, maybe taking 5 minutes, because you have some sort of smart contract which can verify your identity, maybe verify you passed your driver's exam, and then can go ahead and print out some sort of identification document. Or even land ownership, instead of a file cabinet with a bunch of old documents, bringing it onto a new modern blockchain with smart contracts so that you can very easily transact land that way. Avoid having realtors, for example. So the final thing, and one of the coolest things I think, is bringing robotics into the fray. And one of the issues with smart contracts, and even just blockchain and cryptocurrency in general, is that it's all in its own little kind of online digital bubble. And potentially, we could maybe use smart contracts and robotics to kind of bring like the resolution of smart contracts into the physical world. And you can kind of let your imagination go wild here, but it's bringing the decentralization of cryptocurrency and smart contracts and bringing it into the physical world. And I mean, I could go on and on about how this could play out, but it's I think one of the coolest things about the future of crypto is kind of bringing these innovations into the physical world. And yeah, and that about finishes up the presentation. I wanted to kind of leave it a little bit lean just to open it up to any sort of questions that people might have. But yeah, that's all I got.
I got 2 questions. One is, can you elaborate on your last one? I don't get how the robotics and the smart contracts work in a physical. I got lost there. The second thing is, so Bitcoin, for instance, is at astronomical 65,000 and going up. What is driving that? Is that similar to the stock market? But the stock market has a PE ratio of what you expect the earnings of a company to do. But there's generally economics is all based on confidence and people's feelings, right? Is Bitcoin being driven by is that astronomical rise or any rise in it the potential of, and that's what's the buzz of it that's driving it? I mean, what drives the actual value of it?
Sure. So in general, I would say the thing that drives the value of Bitcoin, and the only reason why Bitcoin is valuable, is because people think that it's valuable. And it does definitely have a lot of use cases. One use case that I'll say is, if I said to you, how would you send $1 trillion in cash from the US to Zimbabwe? Okay, that would be extremely difficult. You might have to have some sort of envoy. You have to get the barrels of the cash, stick them on a ship. You have to worry about people maybe taking over the ship because you're sending $1 million. But with Bitcoin, you can send essentially any sum of money extremely easily. Now, one of the issues is that sending small amounts of money with Bitcoin really isn't very viable, but it's something that scales up infinitely. You can not instantly, but within 20 to 40 minutes, send $1 trillion worth of value just like that. So that would be one of the use cases that I think people are approaching in terms of Bitcoin, in that, if you're investing in gold as a store of value, how are you going to transact that gold? How are you going to move that gold around? This gold is sitting, it's very heavy. It's, it's in these Federal Reserves. This is something that's digital, and that gives it a lot of benefits in terms of transacting money. So, but to kind of elaborate on that, you kind of asked about what's driving the value of Bitcoin right now. So one primary thing is just speculation. People see the price going up, and then they say, oh, well, the price is going up, so I should buy it so that I can make money. And then when they buy it, the price goes up more, and then the next set of people say, oh, well, it's going up, it wouldn't be even more, I should buy into this. And then that kind of spreads, and then before you know it, people are buying, and the price goes up and up and up, and they're telling their friends, hey, you got to buy. And so this is that speculative, bubble that causes the rise of Bitcoin. And eventually, most likely, it will crash, just like it has hundreds of times before, not hundreds, but tens of times before in the history of Bitcoin. It went up to $1, crashed to 30 cents, went up to $10, crashed to $1, went up to 1,000, crashed to 100, went up to 20,000, it's up and down, but over time, the trend has been upward. And what I would actually describe, and when you get into the economics of Bitcoin, I would describe Bitcoin as a deflationary currency. So there are only a certain number of Bitcoins that will ever exist. The blocking reward will be halved until no new Bitcoins are introduced into the system. And because of that, Bitcoin is deflationary. Compare that to our monetary policy. The United States monetary policy is one of inflation. We require a 2 to 3% inflation rate for our economy to work. That's just how our monetary policy works. So in general, if you compare the value of something where the number of units of it is going to decrease and that it's deflationary, to something where the units of it are always going to increase, being inflationary, the deflationary asset will always increase in price when you peg it to the inflationary asset. So that's one of the underlying economic drivers that I think is going to see the price of Bitcoin going up, is just because it is deflationary. No new Bitcoins are, some Bitcoins are being created, but less and less Bitcoins are being created, but more and more dollars are being introduced into the system. So if you look at the value of $1 versus one Bitcoin, Bitcoin is always going to increase relative to the dollar.
So unlike dollars, unlike the monetary, because right now we're just printing money, there is never a situation in the future where they'll ever make more Bitcoins.
So the answer, simply, yes. But it gets a little complicated in that, in a sense, the Bitcoin currency is like, it's an agreed upon protocol. And so there have been forks of the Bitcoin protocol. You may have heard of Bitcoin Gold or Bitcoin Cash. So these were just, they took the blockchain and they what's known as forked it. And they just said, we're going forward and we're making a new blockchain. It's this basically the same as Bitcoin, but it has these small changes. And then they call it Bitcoin Cash. So hypothetically, in the future, somebody could fork Bitcoin and bring back the block halving rewards. But in general, I do not think that the Bitcoin that we see now, no, I do not think that any new Bitcoins are going to be introduced in the way that we think about Bitcoin, just because the current protocol is extremely resistant to change. It has been around for 10 years and the code has barely changed just because of how much people have invested in the current protocol. Yeah, and also your first question about robotics. So this is, I think, a little bit of a new concept, something that I've been thinking about recently and also just been reading about. So I don't think I can give you a really in-depth answer. But the idea of adding robotics into the mix is about bridging the benefits of smart contracts and bringing it into the physical world. Because if I have just cryptocurrency and I say, if this cryptocurrency raises in price this much, then sell this cryptocurrency in the terms of decentralized finance. But it's a lot harder to say, okay, well, if you give me money for a product, then send the product to this person. So that might be something where robotics come into play. If you wanted to create almost like a decentralized Amazon, because Amazon runs its own transactional system where you give it money and then it handles the logistics on the back end in terms of actually shipping, that package to your house. But hypothetically, if you could bring smart contracts into the world of robotics, right now Amazon already uses robotics and is automated to some degree. If you could have the programming of those robotics be determined by these smart contracts, you could actually have a decentralized Amazon, a decentralized network of robots and code, which you give it money and then it resolves, oh, well, I need to send this package to this person, and those robots actually take care of that whole thing. So, that's just one example, but the kind of concept is bringing this idea of these smart contracts and bringing them into the physical world, because right now they only exist in the digital. And the only way that I see of bringing it into the physical world is by actually using robotics, because robotics can run on that same sort of language. So it looks like we have a couple questions in the chat, so I'm going to go take a look at those. All right, so we have one question. PayPal is now accepting payments in Bitcoin. If Bitcoin is limited to 7 transactions per second, how is it possible to process so many transactions? I believe that has to be a reason for PayPal, Tesla, and other companies to adopt a cryptocurrency as a payment. However, we still have the scalability issue. So there's a couple terms. So we'll say there's on-chain and there's off-chain transactions. So in the case when you're purchasing PayPal or when you're purchasing Bitcoin on PayPal, you are not doing what's known as an on-chain transaction. So that transaction is not going to count towards those 7 transactions per second. When you purchase Bitcoin on PayPal, you are entering into an agreement with PayPal that says, I have given you money and you owe me Bitcoin. And you can then transact it through the platform. It's kind of similar to Robinhood. With Robinhood, when you purchase a share of a stock, you don't really own that stock. You really own an agreement with Robinhood that they own the shares, and then you have given them money, and now you hypothetically own the share. So with specifically PayPal, PayPal is running its own transaction system that is centralized, that allows people to trade Bitcoin without actually running transactions on the Bitcoin chain. So Bitcoin still has a scalability problem, but also a lot of the ways that people have exposure to cryptocurrency is through places like Coinbase or places like PayPal, where even though you own cryptocurrency in that you are agreeing, PayPal has like 1,000 or 10,000 Bitcoin, and then there are a bunch of people who in their balances, if you add it up, adds up to 10,000 Bitcoin, and then they can technically transact out. But I mean, one note even, I'm not even sure if you can actually transact Bitcoin out of PayPal. Like with Coinbase, if you wanted to, you could transact your Bitcoin that you purchased on Coinbase into your own wallet, your own Bitcoin wallet. But I'm actually not sure if that's possible on PayPal. I believe in PayPal, you actually have to kind of buy and sell only within the app. So that just kind of, I hope that kind of clears up this idea of scalability and what other platforms are doing, because PayPal isn't actually putting these transactions on the chain. They are just doing the transactions internally in a centralized manner. So I have another question. Smart contracts are net new and create new opportunities, but some are disruptive and cheaper by their very nature. Can you speak to both GENERATION-SCALABILITY, I think governments and large companies' future role in accepting, fighting, or driving smart contracts or decentralized finance? That's a good question. So I really hope that we can start to see smart contracts being used in large companies and in governments, because as you mentioned, they are disruptive and cheaper if done correctly. I think it's going to be a very slow process, especially if we look at the government side. I mean, you know, if you look at our current bureaucracy and what it runs on, I mean, we're not even running on, you know, what is established to be just good technology now. There's a lot of paper, there's a lot of bureaucracy, and it kind of comes down to government and efficiency. So even though I think that smart contracts would be really well suited for government use cases, I worry that the time frame on that is going to be pretty large. As for large companies, I mean, it's really, I guess it's difficult kind of to say. I think it depends on the sector. I think financial companies have been actually working really well with decentralized finance, and there's been a lot of new kind of decentralized finance companies just in the space. So I don't know if people would, or these large companies would really see it as a competition. I'm not sure if they would fight it. I mean, this is really all speculation. I think that smart contracts and blockchains, you know, they're more of a technology that hopefully different companies can use, as opposed to something that, you know, some sort of industry that people want to fight against. Let's see. Yeah, so Jen mentioned that you can't actually transact Bitcoin out of PayPal. Okay.
So,
well, I think that, yeah.
If I can just poke in for a second, I said I would make sure that we'd kind of get you to talk about this quickly. You know, Coinbase didn't do an IPO today. They did a direct listing. It went, you know, bonkers. What is Coinbase, and you know, can you think of any major implications that there are in the market as a result of them getting this direct listing on the stock market?
Yeah, sure. So Coinbase is how I would describe it is probably the first safe and consumer-facing application for users to transact with Bitcoin. And something that has been really common. Oh, and Jen just asked, what does direct listing mean? So essentially, direct listing is they aren't issuing new shares. They are just saying you can now purchase shares from people who own shares in the company. So, if I invested in Coinbase like 10 years ago, then now I can sell my shares on the open market. Normally with an IPO, which is kind of the difference to direct listing, with an IPO, I believe a lot of shares are actually created, and IPOs are more seen as a way to raise capital. They say, normally, if you're raising money in a company, you'll go to a round and you'll be like, hey, like we were looking for investment, and then you give a portion of your company away for funding. With an IPO, you're opening it up to the market and you're saying, we're going to be selling these shares at this price, and then the market can go and actually enter into it. So an IPO is more for raising capital. Direct listing is just, previously it was private. The shares that people owned could not be traded on the open market, and now they can. And I think, Andrew, you might have wanted to add something.
No, you got it.
Okay, great. So to get back into Coinbase. So as I was mentioning, Coinbase is one of the first safe and consumer-friendly applications for transacting Bitcoin. And Bitcoin and other currencies. So one of the big issues with cryptocurrencies and exchanges with cryptocurrencies is that they have been notoriously unreliable. And the difficulty with Bitcoin is, at least in the very beginning, it's like, how do you get Bitcoin? The only people who have Bitcoin in the beginning are miners, and then they can only send it. So if I wanted to get Bitcoin back in the very early days, it's pretty difficult for me to actually transact that. So there were some exchanges that existed, but the issue with an exchange is that generally they take control of people's coins. So I send them 2 of my Bitcoins, and then now I can transact with those Bitcoins on the exchange, and I can buy them and I can sell them. But the issue there is a lot of the beginning exchanges were very vulnerable to hacks, and also just to people being like, oh, well, I'm just going to take all this money. So one of the very first exchanges, known as Mt. Gox, was hacked. And I don't know the number. The number keeps increasing as time goes on, but it was probably $1 billion heist or hack where people just ran off with all the money in the exchange. So, Coinbase, it's one of the kind of first applications that really was viewed as safe. People trusted it with their money to hold their cryptocurrency. And also Coinbase has shown through their security efforts, and they've gone through a number of very serious like hacking attempts, and have shown that, they are safe. And the way that I would actually really compare it is, in maybe the Wild West, you had people running around, you stored your cash under a mattress, and sometimes someone might just show up at your house with a gun and just take your money. And then you had banks, and banks had more of a secure way to store your cryptocurrency. They had vaults, they had tellers, they had security. And Coinbase is kind of what I would describe as that iteration of it. It's a place that people viewed as being safe to store your cryptocurrency, and storing cryptocurrency has its very own unique challenges, which I won't go too much into detail, but protecting your private keys, it's a very different, innovation. Coinbase, one of the reasons why they're so valuable is just because they were one of the first to really do it correctly, do it safely, and gain the trust of consumers, so that consumers trusted them to hold their cryptocurrency and to transact their cryptocurrency. As for what it says about the industry, I think that Coinbase going on direct listing, it being most likely $1 billion company, that definitely shows people are adopting cryptocurrency more. And when you look at the state of the industry, you look at the number of companies being funded, and you look at these, what I would say is large infrastructural projects, because that's what Coinbase is an infrastructural project that supports Bitcoin. It makes it safer to actually enter into the industry and purchase Bitcoin. So these very valuable kind of infrastructural companies, I think, definitely bode well for cryptocurrency in general, because it makes it easier and safer to transact these cryptocurrencies and use these cryptocurrencies.
Thank you for that.
Yeah. So are there any other questions? All right. Well, if there's nothing else, then I think that's all I got.
Fantastic.
So thanks, everyone. I appreciate everyone for showing up, those who stuck around the whole time.
Jen wants to know what your favorite snack is.
What's my favorite snack? I really like really spicy chips like Takis. I don't know if people have had Takis before. They're basically like terrible. What's that?
Half a Bitcoin.
Oh, sorry, I didn't hear you.
You're gonna eat half a Bitcoin. That is an expensive meal.
Exactly.
All right. Well, yeah. So I guess I don't know where we move on from here.
Well, so
yeah.
I mean, so as we said at the beginning, you know, our next talk is going to be May 12th. With next in line is Pepe here. He's going to be talking about Agile stuff. It's going to be great. Looking forward to that. We will be sharing this recording probably within the next day or two on the Ambassador YouTube. We'll put it up everywhere. You know, we'll throw it in Discord. We'll throw it in whatever Telegram groups we remember exist. Hive, Bright, LinkedIn. I don't know. We'll come up with a lot of different ones. But yeah. Thank you so much, Birch. It was a great presentation. Thank you all for coming, and we will see you all next time.